And we're getting straight into market discussion here. Perhaps let's get your view on global equities right now, because yesterday we had the markets strong and then we've got this dip back coming through today. And it seems that it's a dip back that comes through as investors start to digest all that stimulus measure that was announced yesterday by President Barack Obama, and that disappointment very quickly setting in.
The market was expecting at about $300 billion. So when he announced $450 billion, it was a lot more, it was quite a bit more than expected. And I think it will do the job possibly in the longer term. It will create jobs, it will create infrastructure spend. It will also give people, you know, on social security benefits, a bit more money to spend. However, the problem that the market is realized that, you know, the benefits won't come through immediately. It'll take some time to come through. And also there might be some hurdles in Congress when it comes to passing it. Although initial indications are that, you know, it will be passed through and there's a seriousness about it. But it also on the other hand says that the US economy is in trouble, and that's the other message that's coming through, and possibly that's the reason why the market initially reacted a bit negatively, but we'll just have to see with the passage of time in terms of how the spending is going to come through. It's very similar to, I think, in the South African market, where infrastructure spending, there's a dire need for it. And in South Africa, we've also been, government especially, has been really, it's been taking them some time to get infrastructure spending, the processes, the bureaucracy of getting it done, and, you know, the whole tender processes and everything, and the indecision has also been a contributing factor. So I wouldn't be surprised if the US suffers from the same indecision when it comes to spending.
What are you making of all the to and froing that's happening, and this on a global scale where, as you say, the market is demanding decisive action at this point of the game, where so far all the to and froing has done is triggered a crisis in confidence?
Yes, you can see that in the developed world. You can see it in Europe. In Europe also, there's a lot of indecisiveness. One can understand why that's the case, because the Greeks have not really been keeping to their side of the bargain when it comes to, you know, austerity measures. The Germans are getting very unhappy about it. There are also elections coming up. So, you know, the governments of Europe also have to be very mindful of whether they'll be in power the next time around. Germany is in a very difficult situation where, you know, that the political government could be voted out. So they've got a balance between, you know, on the one hand, nobody in Europe can afford a default by Greece. And if that happens, it will be, you know, catastrophic for the world as a whole, because the banking sector will most likely implode. You can see also in the Greek the Greek two-year bonds, what's happening there. It's gone up again. The spreads have gone up again, and it's basically saying to you that, you know, there's a good chance of the Greek government is going to default on it. But I however, think it's an unlikely event, because the European governments won't allow it. I think the US might also step in to prevent something like that from happening. There's a possibility that the Greeks might exit the euro. I'm not too sure that will happen going forward.
So we're not short of proposals, but certainly short and lacking of decisive action. What good does a meeting like that of the G7 finance chiefs, which were sitting on the threshold of today for this weekend, actually present to the markets?
It's obviously more uncertainty, because as you're going forward, markets don't really like uncertainty. You can see that the markets have already come down quite a bit already. So it's, in a sense, to a certain extent, pricing in, you know, the uncertainty that's coming through. If you look at the bond markets, both in the US and in Europe, they're already pricing in, you know, some sort of recession, at least possibly a 50% chance of a recession, both in the US and in Europe. So the bond market is saying to us one thing. The equity markets, I mean, at the moment is in my view fairly priced. However, it could potentially come down for various reasons, which I'll touch on later. But this uncertainty that's in the market, whether it's in the US, whether it's in Europe, is not good for markets as a whole.
Amidst this uncertainty, Asief, what are you pricing in terms of a possible recession emanating out of the US or a European sovereign default?
My view is that there's a 50% chance that the US might go into recession now. If you look at the US equity markets, although if you look at the historic multiple of it, the long-term historic multiple is 15 times. On a forward basis, it's anything from 12 times to 13 times PE multiple. And that's not overly expensive or cheap. What, in my view, it's probably fair. Mm-hmm. So so if I'm saying it's fair, but on the other hand, there are a number of risks out there, as I've outlined earlier, the sovereign, the sovereign issues in Europe, but also in the US, the operating margins of S&P 500 companies is close to a record high. And the reason why they're close to a record high is because the last recession, they've managed to cut costs significantly. They've become a lot more efficient. And what's happened is unemployment has increased. However, going forward, it looks like sales of S&P 500 companies might start declining. And as they're declining, margins will decrease. The US companies won't have the opportunity of cutting costs because they've already done that. So as margins decrease, mm-hmm. you might have a negative surprise of earnings growth, which the US market you're expecting of about 10% going forward. That might go down or it might stay flat. So the market, there's potential for disappointment. I'm generally cautious about US markets and also European markets because of the number of risks that's around that I've outlined.
Just looking at those risks, Asief, because when we're looking at declining sales, not only on account of a consumer under pressure as a result of the jobs market, but also you highlighted off air to me the fact that we're looking at the baby boomer phenomenon taking place, where you've got those baby boomers now retiring, and that might depress earnings and so multiples moving forward.
Yeah, that's a very important consideration. We know that the baby boomers are starting to retire. However, this phenomenon might play itself out over the next 10 to 20 years. What's happening is that the baby boomers will start drawing down on their savings. They will be withdrawing from equity markets. And if you look at the history, the ratio of baby boomers to let's say the age groups of 40 to 49, that ratio relative to the age group of 60 to 69, what's happened is that ratio was quite high, and it's correlated nicely with the price earnings multiple of the US market. So it could justify at some stage a multiple of 15 times, 16 times when that ratio was quite high. But as the baby boomers are starting to retire going forward, what will happen is that the ratio will be going down. So for the next, possibly for the next decade or two, the PE multiples coming down from 15 will probably go down to below 10. So that will also be a drag on equity market performance, US equity markets performance specifically going forward. And the returns from equity markets over the next decade or so won't be as high as you had since the early 1980 to about 2000.
So, Asief, when it comes to your approach to the markets, then are you viewing now as a buying opportunity, or are you waiting for things to depress even further?
We cautiously positioned and defensively positioned. So I'm waiting for a bit more market pullback. Before you would increase the equity exposure in this market. However, there are some opportunities where stocks have really underperformed and where earnings are well below normalized levels. An example could be the multinational pharmaceuticals, mm-hmm. in global multinational pharmaceuticals. Their PE multiples have fallen below 20, well below historic means, mean averages. And that's potentially an investment opportunity there. The other area that I would look at, that is a defensive company that I still hold on, is a company like British American Tobacco, where there's not a lot of competition in it. And it's been around for, and it's been increasing profits and margins for some time now. And it's a company that's considered defensive, where I would also be invested in. On the one side, I'm saying British American Tobacco, where you can get good profits, but they also make you sick, so you'd end up in hospitals. And then the other side, I'm saying, the pharmaceutical companies, which will benefit not only from the people who go to hospitals because British American Tobacco possibly put them there, but also because of the baby boomers that's retiring, and they will, at that stage, as they get older, they'll need a bit more healthcare and buying more drugs in older age. And as you know, closer to, in old age, you spend a lot more in terms of medical expenses.
So you're backing for one in some way, supporting your investment in the other. Let's bring it back home and take a look at what you're making of valuations on home ground, because, you know, where you're waiting for things to fall even further, you know, maybe not extremely so, but fall back nevertheless abroad, where people have already been talking about low valuations on offer abroad. What's your sense of valuations on the markets here in South Africa?
The valuations in the South African market is also, I would define as fair. It's on a 10 PE multiple. It's not overly expensive or overly cheap for that matter. However, margins have also increased because of commodity prices being high. Commodity prices have been high for some time now. The only risk to the South African equity market is if commodity prices fall, if China slows down. I don't think China and India will slow down significantly. There will be a slowdown, but not as significant as some market participants are expecting. Some of the companies like Anglo-American PLC is already pricing in for a slowdown of commodity prices as in a PE of 6 times multiple. So what I'm saying is the market to a certain extent is already pricing in some sort of fall in commodity prices. However, the other aspect is margins might detract, might contract going forward, and that might put a bit of pressure. However, I think our market is in the fair to slightly cheap side relative to international markets.